Still with me in studio is Rayland Dunbar, Financial Advisor at Finlogic, Peter Carlisle, Director at CTF SA, and SARS's Nathaniel Mabetwa, and he's the Group Executive of Taxpayer Services. Now, before we continue with our discussion, let's take a quick look at another viewer's question we received. It's from Sarah in Rand Park Ridge, and she asks, I'm an employee and have underestimated my travel allowance for last year. Can I have a claim for additional costs? Now, I'm going to go straight to the tax practitioner for this one. Peter, your response to Sarah there.
In terms of a travel allowance per se, no. If the travel allowance, the deduction that she's entitled to will be limited to the travel allowance that she received. So she will not be able to claim any more against the travel allowance. However, if Sarah is a commissioned earner, and there the Act refers to mainly, if she earns her income is mainly commission based, the courts have defined that as to be more than 50%. If her income is more than 50% is commission based, then she will be entitled to claim expenses, the direct costs incurred in order to generate that income, that commission-based income. So the person then would be, the taxpayer would then be able to claim the motor vehicle running costs, the fuel, the maintenance, the capital cost, etc., of the vehicle, but it would not be based under the travel allowance per se.
Okay, so this really sits outside of it. Key question, do you earn more or less of your income in commission, or any at all? I think that's the next thing.
Yeah, it's a 50% rule is quite important. SARS does adhere to that quite closely.
Okay, so more than 50%, you may be in with an opportunity to claim. Under 50%, then potentially not. If it's been a bad year, unfortunate for you. Rayland, we spoke a little bit about deductions. We mentioned medical aid, retirement annuities. The other one's income benefits, and I know this is another area where the industry, from an insurance point of view, has been very pro lump sums in the past. Now we're seeing the income benefit coming into its for one of the reasons is tax benefits. Maybe you can take the viewers through that quickly.
Yeah, it's really important for people to realize that any kind of income protection products that they have, whether it be sickness or disability income protection benefits, the actual premium is tax deductible, which effectively means whatever your marginal tax rate is, you're effectively getting that percentage back as a tax saving in terms of your return. So it's quite important for people to realize that they can actually deduct for these things. And the reason really for this is that your income protection products are tax deductible, because when you're receiving the income and the proceeds, if you become disabled or off sick for a long period of time, you're in a position where you're going to pay income tax on those benefits. So it's something that people need to be aware of to make sure that they are deducting. Otherwise, effectively, you're paying it after-tax money towards your premium, and if and when you're receiving your income, you're going to be taxed on that as well. So it's quite important. But a lot of people are using those benefits because, quite honestly, it's not as though a large percentage of people do claim from these benefits. So getting the tax break in terms of these benefits is often much more beneficial than being in a position where you're just going to get a tax lump sum, or a lump sum effectively that is tax-free from a capital perspective in terms of disability.
Or rather get the tax benefit on something that you've got certainty on, right? And of course, a taxman will eventually get his fair share. The other side was really the pension and retirement annuities, and I know there's been a little bit of uncertainty around that. Perhaps you could pick up on that quickly.
Okay, retirement annuities are obviously completely tax deductible, and again, we're just talking now about the previous tax year. The idea really is that if you are contributing towards a retirement annuity plan, and obviously it's dependent in terms of your non-retirement funding income. So what would really happen is that you need to take into consideration if you've got a pension or provident fund in place with your company. Based on that amount, there's going to be generally a percentage that is now regarded as retirement funding income. That is the percentage of salary that your actual pension or provident fund is calculated on. The non-retirement funding income, which is usually things like your travel allowance or rental incomes or any other kind of income or commission, for example, that is not formed part of your actual retirement funding benefits, that is regarded as non-retirement funding income. Now, effectively, a person is allowed to contribute up to 15% of their non-retirement funding income towards a retirement annuity plan, which then is obviously tax deductible in their hands. And the idea really is that people are being encouraged to be able to contribute towards their retirement plans, take a lot of onus off of government effectively so that they're not claiming on the state when they retire. And by looking after yourself, you are actually achieving the tax break in the process. In addition to that, in a retirement annuity plan, people don't actually pay tax on their proceeds and the growth that happens in those funds. So it's really important that people make sure that they use these entities correctly. Also, if people are in a position where they are contributing to a retirement annuity plan, but they are already contributing their maximum in terms of their pension and provident fund, they need to either, if they are contributing still to a retirement plan, they need to make sure that they keep records every single year of what was not allowed in terms of that deduction. So that one day when they come up to their retirement age, they can then be able to prove that and obviously deduct it tax-free.
Obviously, Nathaniel, I mean, we're having a look at it here. There's a lot that SARS expects, but they're willing to give back as well. What are some of the common mistakes that people are sort of coming across when looking at those deductions?
Well, the common one is that people do not bring in their certificates. So if you're going to be going to the branch office to submit your return, we find that people pitch at the branch offices without all the required documents. Even when doing e-filing, we've also picked up that people leave out some of the stuff and have to come back and ask for a revised assessment or object, to an assessment. So I think the advice that has been given is quite sound. So, make sure that you have all your documents, get your certificates before you start the process of filing.
And I guess that goes for across the board, regardless of what it is that you're trying to claim against. Have the proof, have the certificates, have the documentation in place. If you've got that, it should be a lot easier for you to claim and actually do your submission easily. Peter, we're almost out of time. Just quickly from your side, I mean, common mistakes, what is your advice to people out there?
Well, I think one of the areas, just to detract a little bit, is on provisional tax. SARS has gone quite some way at the moment to improve their provisional tax returns. And this new one this year is a complete electronic version, which is quite nice and it's fairly user-friendly. But there's one serious flaw that it has, and maybe Nathaniel can assist us with this. But in terms of paragraph 19 of the fourth schedule, SARS has the discretion to reduce the basic amount in the event that the taxpayer can demonstrate that the actual taxable income is going to be less than the basic amount, which is the previous assessed amount. Yet on the return itself, there's no facility for the taxpayer to physically put in and to indicate to SARS why they're going to use an amount that is lower than the basic amount.
Okay, so potentially, something to pick up on there. I'm sure we can discuss this a little bit later. Rayland, final thought. What is it that you've got as a tip to taxpayers out there in this 2010 filing season?
Most importantly, get your tax certificates. Make sure that you're claiming all the deductions that you possibly can. It's really important. You don't want to be paying too much tax. Provisional taxpayers, people that are on commission basis, etc., have got a whole lot of additional things that they can claim for in Section 11A of the Act. That basically means anything in production of your income can be claimed for. Things like, I'll go into the tips now, but there's a lot of details that need to be looked at, and people need to make sure that they are deducting correctly.
Okay, well, we're looking forward to that. Nathaniel, Peter and Rayland, thank you so much for your time tonight.
You're welcome.
Before we go, it's time for a quick look at our weekly viewers' tips, as Rayland said, and this week they relate to this year's tax season.
Franklin Roosevelt said, "Taxes are dues that we pay for the privileges of membership in an organized society." Yes, it's that time of year again. Tax season has begun. If you are a resident and spend most of your time in South Africa, you are liable to pay tax on your worldwide income in South Africa. Get registered on e-filing. It's the easiest and most user-friendly way to submit your tax returns and get an automatic extension until the 26th of November. Remember to include your capital gains and losses in your tax return. In our next episode, we'll be focusing on capital gains tax, so don't miss it. Always keep all records of previous returns, as if there is a discrepancy or if SARS audits you, you can easily provide the information needed. Self-employed people and commission earners have a number of additional deductions which are allowed. So here are a few tips to remember. You can deduct for accounting fees, including the fee charged by a tax consultant to submit your tax return, and you can also claim for bank charges. If you hold professional insurance or even have specified items on your short-term insurance, such as your cell phone or laptop, you can claim insurance premiums from tax. If you purchase professional magazines, newspapers, or other professional literature specific to your business, you can claim these from tax, so keep those slips. With the escalating costs of parking and the new introduction of additional toll fees, keep records and claim the costs. You'll be surprised at how these small amounts equate to a large amount over a year. Depreciation can be claimed against tax on equipment such as your laptop, which you have bought and utilized for business. Even a salaried employed taxpayer can claim for limited depreciation under the right circumstances. All taxpayers who submit their tax returns must remember to get all contribution certificates from the relevant insurance companies and claim for deductible premiums, such as medical aid, retirement annuities, and sickness and disability income protection products. You will also receive contribution certificates for investments, savings, and unit trusts. However, these can be claimed against your tax exemptions under interest, CGT, and dividends. If you are uncertain what insurance products you have or which ones you can claim for, please contact Finlogic so that we can assist you